Howdy, y'all. Welcome to Liberty Call. Today is Thursday, July 25th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. It's getting warm again this week, so we got some hot weather coming again this weekend. So yay, yay, yay. I'm excited about that, especially without air conditioning. So anyways, all right. Well, looks like the markets took a crap this afternoon, and, I guess, there's just not enough buyers out there and too many sellers at the moment. So anyways, well, if it is your first time watching Liberty Call, if you could give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. All righty, let's get into today's numbers. Dow Jones was up 0.2%, 81 points, closed at 39,935. S&P 500 down 0.52%, 28 points, closed at 53,98. NASDAQ down 0.93%, 162 points, closed at 17,180. The VIX was up 2.38% today. It's at 1849. Canada down 0.14, Brazil down 0.26, and Mexico down 0.45. Headed over to Europe, Germany down 0.45 also, the UK up 0.4, France down 1.15%, the Netherlands down 0.54%, Spain down 0.58%, Italy down 2.03%, Switzerland down 0.75%, and Portugal down 2.61%. Russian exchange is split today. The MOEX down 0.39, RTSI up 0.94. And the overnights, the Nikkei in Japan was down 3.14%. Wow, that's big. Australia down 1.29, New Zealand down 1.72. In China, the Shanghai was down 0.52, the Shenzhen Component down 0.22. China A50 down 0.74, DJ Shanghai down 0.44, Hang Seng down 1.77. And the Taiwan weighted when it closed on the 23rd was up 2.76%. All right, so looks like most of the globe was in the red today, so some unhappy traders out there. All right, let's get to the market recap. S&P 500 rebounds from recent rout as dip buyers emerge. The S&P 500 advanced most of the day on Thursday, driven by buying interest in tech stocks and rising expectations that the Federal Reserve may implement multiple rate cuts this year. IBM surged over 5% following optimistic remarks about growing demand for its AI offerings and an upward revision of its annual cash flow guidance. RBC noted that IBM's Gen AI business has expanded to over $2 billion since the launch of Watson X, exceeding expectations. ServiceNow soared 15% after reporting quarterly results that exceeded Wall Street expectations and raised its annual guidance. Oppenheimer highlighted the sustainability of ServiceNow's strong performance, citing prioritization of back-office solutions in 2024 IT budgets and increasing adoption of non-technology workflow solutions. Tesla rose more than 3%, rebounding from its biggest single-day drop in nearly 4 years, following its recent weak quarterly results. U.S. gross domestic product, or GDP, grew by 2.8% in the second quarter, surpassing forecast of 2% growth and improving from the 1.4% growth seen in the first quarter. The prices component, an inflation gauge, fell to 2.3% from 3.1% in the first quarter, suggesting easing inflation pressures. The data has bolstered hopes that the Federal Reserve might cut rates more than once this year, starting in September. However, durable goods orders declined 6.6% in June, contrary to expectations of a 0.3% increase. American Airlines increased over 4% despite lowering its annual profit forecast due to weaker pricing power and overcapacity in certain markets. Hasbro gained 3% as the toy maker posted a smaller than expected drop in second quarter revenue, with strong digital gaming demand offsetting a slump in toy sales. Cost control measures helped it surpass profit expectations. Ford plummeted over 17% after disappointing earnings as automobile sales slowed significantly amid decreased consumer spending. And to finish up, Lineage Inc. climbed over 3% on its NASDAQ debut, trading at $80.81 after opening at $82.20. The cold storage company priced its initial public offering at $78 per share. All right, so that is a day in the market. Let's get over to some of the data. Second quarter GDP. This comes to us via Robert Stein at First Trust. All right. Despite positive headline figures, dark clouds are forming over the U.S. economy. Real GDP grew at a 2.0% 0.8% annual rate in the second quarter, surpassing the expected 2%. The growth was primarily driven by consumer spending, which has increased at a 2.3% rate. Notably, business investment in equipment surged by 11.6%, the fastest pace over 2 years, likely due to AI and chip-related investments. Core GDP, which includes consumer spending, business fixed investment, and home building, while excluding volatile government purchases, inventories, and international trade, increased at a healthy 2.6% rate in Q2, up from 2.9% a year ago. However, not all news was positive. Net exports were a 0.7% point drag on growth due to a surge in imports, partly driven by importers trying to get ahead of potential dock worker strike. The import surge contributed to inventory accumulation, adding 0.8 percentage points to real GDP, a trend unlikely to continue. Inflation remains a concern. GDP prices rose at 2.3% pace in Q2 and were up 2.6% from a year ago, down from 3.5% annual increase a year ago, but still above the Fed's 2% target. Nominal GDP, which includes real GDP growth plus inflation, increased at 5.2% rate in Q2, but is up 5.8% from a year ago. While the current economic indicators suggest moderate growth and decelerating inflation, analysts and investors have may prematurely conclude that the economy is out of trouble. However, the impact of tighter monetary policy implemented over the past couple of years may not be fully realized, suggesting potential challenges ahead. The lags between monetary policy and its effects on the economy are long and variable, and the storm may still be brewing. All right. Good stuff. Let's get on over to our next bit of data, June durable goods, and this was prepared by Andrew Opdyke of First Trust also. All right. Orders on durable goods experienced a significant decline of 6.6% in June, marking the largest monthly drop since the pandemic-induced shutdowns of March and April of 2020. This steep decline was primarily driven by a sharp fall in transportation orders, particularly aircraft. Despite the alarming headline figure, the underlying details of the report were more optimistic. When the volatile transportation sector is excluded, durable goods orders actually rose by 0.5% in June, surpassing expectations. Several major categories reported gains. Machinery orders increased by 1.6%, electrical equipment 1.3%, computers and electronic products by 0.8%, and fabricated metal products by 0.2%. The only category to show a decline was primary metals, which fell by 0.1%. The key metric of core shipments, crucial for calculating business investment in GDP, showed a modest increase of 0.1% in June. However, these shipments declined at a 2.3% annualized rate in Q2 compared to Q1, the largest quarterly decline since Q2 of 2020. This indicates a significant moderation from the surge seen in late 2020, which was fueled by PPP loans and stimulus payments. Shipments have now declined in 2 of the last 3 quarters. While GDP readings remain positive, as reflected in today's Q2 GDP report, the economic trend is expected to continue displaying turbulence due to the lagged effects of the Federal Reserve's monetary tightening. In other economic news, initial claims for jobless benefits fell by 10,000 to 235,000 last week, and continuing claims dropped by 9,000 to 1.851 million. These figures suggest continued job gains in July, albeit at a slower pace. Overall, the headline durable goods orders figure is concerning. The broader economic indicators suggest a more nuanced picture, with some underlying strengths persisting despite the challenges posed by ongoing monetary policy adjustments. So it's kind of right now. It's like, which way is it going to go? Bad or good? All right. One last article from the Mises Wire. This one titled, "Have We Been Living in a MMT World Since 2008?" And MMT is modern monetary theory, which, not good. All right. In his critique of modern monetary theory, or MMT, and its portrayal in the video Finding the Money, Joseph Salerno addresses the arguments of economist George Selgin. Selgin's interview reveals some inconsistencies in his stance on MMT. Initially, he challenges MMT's assumption that resources are generally underutilized and can be freely conjured by creating fiat money. However, Selgin also suggests that post-2008, the U.S. economy has not been constrained by resource scarcity, implying that the Federal Reserve should have implemented more aggressive monetary expansion. Salerno examines Selgin's claim by analyzing the period from Q1 of 2008 to Q1 of 2024 through the lens of nominal GDP targeting. He finds that nominal GDP grew by 92%, indicating an inflationary trend rather than resource abundance. During this time, the annual growth rate of nominal GDP was positive in 62 of 68 quarters. This contradicts Selgin's assertion, as there were few periods where negative GDP growth would indicate underutilized resources. Salerno further critiques the broader monetary policy landscape, noting that the Federal Reserve's actions, which increased the money supply by 178%, contributed to sustained inflation rather than economic stability. He points out that despite recent negative growth in the money supply, the nominal GDP growth rate remained above 5%. The author argues that both MMT and Selgin's monetary disequilibrium theory have a flawed belief. They attribute widespread unemployment to insufficient aggregate spending. This perspective diverts attention from the Austrian economic principle that it is the price structure, not spending, that drives economic activity. Salerno emphasizes that spending is a consequence, not a cause, of money prices, which are determined by market interactions. He concludes that this spending illusion, in quotes, has misled economic thought since the early 20th century, underpinning various macroeconomic schools, including Keynesianism and monetarism. Only the Austrian school, Salerno asserts, correctly identifies the causal relationship between money prices and economic dynamics, thereby providing a more accurate business cycle theory. Good stuff. That's some nerdy stuff, and I just love reading things like that. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to wrong button. Where is it? There it is. Right there, DSAFinancialGroup.com. All my contact information's there. If you need to get your financial crap together, give me a buzz. I'd be happy to help you get your finances back on track and get you on the path of where you want to go, whether it's retirement, financial independence, starting that business you always wanted, whatever it might be. All right. Well, that's, like I said, everything that I had. Hope everyone has a wonderful evening, and I shall talk to you again next time. Adios.